There is a river flowing. There is a boat sailing downstream. There is a boat sailing upstream. Which one do you think will be easier to sail? We all can agree that boat going with the flow of river will be easier to sail. This same concept of river flow is called trend in stock market. Hello YouTube. Welcome to Roller Coaster. There are three pillars on which technical analysis stands: trend, patterns, and risk management. Today, I will discuss trend in detail. There is a saying in stock market: the trend is your friend. It is one of the most important rules in trading. There are two types of trend, which are frequently talked about. One is uptrend, and other is downtrend. There is one more trend, which is rarely discussed. This type of trend is no trend, or it is called by other names, such as sideways or range bounded. You won't believe, but a stock spend majority of time in no trend. Now, one major question that comes in here is, how to identify trend? Identifying trend is one of the most important, and one of the easiest step. Just open a stock chart. If you see the stock moving from down left corner towards top right, it is in uptrend. Technically, a pattern of higher highs and higher lows is formed. If you see the stock moving from top left corner towards down right, it is in downtrend. Technically, a pattern of lower high and lower lows is formed. Now, let us see how a no trend looks like. It would seem stock is caught in a box. A floor and a ceiling is formed. It is not advised to trade in such range-bounded stocks. If one has to take a trade, there are only two ways it can be taken. First, buy the stock when it at floor price and keep a stop loss below this level. Target is near the ceiling price. Second, short sell the stock at ceiling price and keep a stop loss above this level. Target is near the floor price. It is very important to maintain the stop loss. The stock will not always remain caught up in this range. In case the stock breaks the range in direction reverse to one's trade, person should exit the stock. Though I've explained these trade setups, but again I will repeat, it is not advised to trade in such range-bounded stocks. Before proceeding further, let us understand few terminologies associated with stock market. Correction. A correction is a decline in the price of a stock from its most recent peak. Bounce. A bounce is recovery in the price of a stock from its most recent low. Both corrections and bounces look like reversals. It appears that uptrending stock has now started falling, or the downtrending stock has started rising. It works as trap. Sky is the limit. There is simply no target for a market with an upward momentum. If a stock is in uptrend, one should look for buying opportunities after correction. On contrary, people usually sell these stocks, thinking it cannot go further up. Never catch a falling knife. The term falling knife suggests that buying in a market with a downward momentum can be extremely dangerous, especially for the beginners. If a stock is in downtrend, one should look for short selling opportunities after bounce. On contrary, people usually buy these stocks, thinking it cannot go further down. I hope this next example clarifies the picture even more. Tesla is a leading electric car maker company. Tesla's stock price surged 740% in 2020. Tesla's market cap tops the 9 largest automakers combined. Do you think Tesla's revenue or profit is more than these companies? Can you explain this with any logic? No. And here it gets even more interesting. This is news from 11th of January 2020. This is news from 16th of January 2020. And finally, this is news from 23rd of December 2020. There is simply nothing more insane in this market. These are consequences of fighting against market, against trend. One of the most important attributes of technical analysts is never to fight against market. Just participate. There is no one bigger than this market. Follow the price and that's it. No questions asked. There are some key components in market: buyer, seller, product, and currency. Seller has a product or service which he wants to sell to a buyer at a price. This complete process of exchange is called a transaction. In stock market, this product is replaced with a stock. A person makes profit by buying at low price and selling at higher price. Along with this, stock market participants can sell a stock first, even though they don't have one. This is called short selling. In short selling, person makes profit by selling at higher price, and buying at lower price. There are various factors which impact stock market. Geopolitical factors, microeconomic factors, macroeconomic factors, GDP, government policies, company management, etc. But in the end, all of it just comes to one thing: sentiments. These sentiments, especially greed and fear, play a vital role. There is a saying in stock market: buy in fear, sell in greed. And it is very true. The greatest opportunities occur when money managers, investors, and traders panic. They sell off securities to extreme low levels. After they are done selling, the smart money enters the market and takes prices higher. But, if we look closely, greed and fear have a far greater involvement. A buyer buys an item today in greed, to sell it at higher prices tomorrow. Along with this buyer has a fear: if they don't buy it today, they will have to pay more tomorrow. Similarly, a seller sells an item today in greed of profits they are already sitting on. Seller has a fear: if they don't sell it today, they will have to settle for lesser profits tomorrow. These sentiments create continuous demand and supply for an item. Let us understand how this difference in demand and supply impact price. Scenario 1. Item has low supply and high demand. In other words, sellers are less and buyers are more. Buyers will be ready to buy at any cost offered by sellers. This leads to increase in price of the item. Scenario 2. Item has high supply and low demand. In other words, sellers are more and buyers are less. Sellers will be ready to sell item at lower costs. This leads to decline in price of the item. Scenario 3. Item has stable supply and demand. In other words, sellers and buyers are almost same. In these cases, price don't fluctuate much and trades in a range. When we compare these with stock market, Scenario 1 represents uptrend, Scenario 2 downtrend, and Scenario 3 sideways or range bounded. Even if the stock is in uptrend or downtrend, it never comes in straight line. Stock moves in a wave-like structure. When in uptrend, stock moves up to a level, retraces, and then move further up. When in downtrend, stock moves down to a level, retraces, and then moves further down. There are two important concepts here. First, resistance. As the name suggests, resistance is something which stops the price from rising further. Resistance level usually appears near the stock's previous highs. Psychology behind this is to book the profits or to short sell the stock, expecting it can't go further up. Second, support. Support is something that prevents the price from falling further. Support level usually appears near the stock's previous lows. Psychology behind this is to book the profits or to buy the stock, expecting it can't go further down. It is just a common human behavior. Now, let us see how these resistance and support looks in a stock chart. The stock is clearly an uptrend. To an untrained eye, this chart is nonsense. It simply has no meaning. But technical analysts can spot patterns. Please pay attention. This is a high that stock made and faced resistance to move further up. It seems sellers have taken control of stock. It is not able to cross the resistance. But if resistance level is being tested multiple times, it is becoming weak. It is most likely to be broken. If the stock breaks the resistance, it is a buy signal. One should look for buying opportunity above the breakout price. Stop loss is to be placed below resistance level. Beginners can book the profit at 2 to 3 times the stop loss. After a resistance level is broken, this same level starts acting as support level. The stock makes a new high, faces resistance, and corrects. On correction, it is most likely to take support at this level. After a visible reversal on chart, buy signal is generated. One should look for buying opportunity above the reversal. Stop loss is to be placed below this support level. Beginners can book the profit at 2 to 3 times the stop loss. With experience, one should inculcate the habit to hold the stock by updating the stop loss in direction of trade, and try to book maximum profits in a move. I'll discuss these profit booking strategies in coming videos. Before moving to next chart, I'll repeat once again. When a stock is in uptrend, one should look for buying opportunities after correction. This is again an uptrend. Faced resistance at this level. Resistance gets tested multiple times and becomes weak. It gets broken. Now it will act as a support level. On correction, took support at this level. It is in downtrend. This is support level. It gets broken by downward momentum. This is indication for trend reversal. On break, it is a short selling opportunity. One should look for short selling opportunity below the breakout price. Stop loss is to be placed above this support level. Beginners can book the profit at 2 to 3 times the stop loss. In downtrend, after a support level is broken, this same level should start acting as resistance level. It makes a new low, took support, and bounced. On bounce, it faced resistance at this level. This brings even more clarity about the trend. After a visible reversal on chart, sell signal is generated. One should look for short selling opportunity below the reversal. Stop loss is to be placed above this resistance level. Beginners can book the profit at 2 to 3 times the stop loss. When a stock is in downtrend, one should look for short selling opportunities after bounce. I hope I was able to make things clear. Let me repeat few important points. Resistance level appears near the stock's previous highs. Support level appears near the stock's previous lows. If resistance or support is tested multiple times, it becomes weak. Once resistance is broken, it starts acting as support. Once support is broken, it starts acting as resistance. Always trade with trend, and it is must to keep stop loss for each trade taken. There is never 100% accuracy in stock market. These are patterns with higher possibilities. That's it from my end. Please have a look at some charts and try to spot these patterns. And if you have any questions, please post in comments section. I would love to clarify those. Thank you.